Okay. Okay, so welcome everyone to our Meetup called Ask the Experts. This is the one and only show where we talk about real estate investing, and the viewers can come on live and ask their questions. So today our expert speaker is Neil D'Souza. He is a mortgage broker that specializes in private lending. Thank you so much for coming on to my meetup and sharing your knowledge with us.
Thank you so much, Diana, for having me. It's great.
Awesome. So let's start with just a little bit about yourself.
Oh, sure. Okay. Well, I'll start with I'm married, 4 kids, a bunch of teenagers in the house right now, so that's a lot of fun. I worked for the federal government for about 15 years out east, and then we moved back to Ontario because our kids were growing up, and that's when I made the transition into private lending, into mortgages specifically. Although I started my real estate journey years before that, back in 2007, starting with income properties, just personally interested in real estate because I actually grew up in Scarborough, where we put a premium on real estate, not having a whole lot, and so I realized when I wanted to transition out of the government that this was the area that I really loved, and perhaps I started looking on the as a realtor. I thought maybe selling houses was the way to go, and then realized that I was much more mindset. Like I needed a deal, and it's in my blood. So here we go. And I went on to the finance side, and I was very fortunate to have some very powerful mentors that taught me about private lending, and I've been in it ever since, and teaching people how to do it and helping them navigate through that. Right now, we manage somewhere in around $5 to $6 million for my clients at any given time. So, yeah.
Awesome. Thank you so much for sharing that. So
Yeah.
so just to give you an idea. So we've done actually a show last year about private lending. It was specifically geared around people that will do it themselves and how to find a good deal and make sure that you're lending to the right kind of deal. So I kind of want to gear this one more towards the risks, like what are the problems that can come up, and
Mhm.
also just even the difference, right? Because the person we had as a speaker, he was lending out himself. You're a mortgage broker, so we're going to be seeing it from your eyes, which I think is also great. So let's start with, I guess, the difference between, like, why would we want a mortgage broker or why we would want to do it ourselves?
Yeah, absolutely. So, number one, if you wanted to do it yourself, you're coming. There we
Oh,
go.
sorry. Yeah. Sorry. Can you start
Right.
again?
I
I
think I
don't know.
might have muted myself, but
Oh, okay.
yeah. So, at any rate, what I was saying is, as a private lender, you're completely entitled to be able to do it yourself. Where we help out is really being able to transition and give you our services. The number of deals that we would see, the number of, just in terms of the training that we receive for what's going on in the marketplace, being on top of that thing, when you're doing it on that frequent a basis, there's just going to be trends that you're going to see and things you're going to know about that um, that otherwise you wouldn't get grasp and or get in that same time period. The other thing is that a lot of the investors that lend with me or through me, they're they want to learn as they go rather than uh, learning from the failures along the way, right? And so I'm able to really help, teach. There's something I've realized, that there's even that in me, that I enjoy that part of my job, is to be able to teach people those things and share the experiences all around. So, they say that experience is the best teacher. Just try not to make it all your own.
That's awesome. And so now let's talk about, yeah. So what are the things that we should be aware of that would be considered risky, or things that you look into to make sure a deal is good for your customer?
Okay, yeah. So let me start with, first of all, just so we're on the same playing field. A private mortgage is really just the difference between that and the bank's mortgage is that the bank is lending out money that it has borrowed, at the prime rates. We're lending out our own money, and we are actually placing a mortgage onto a property. Any loan on real estate is a mortgage, and so the moment you do that, and if you're the one doing it, it becomes a private mortgage. And my kids always like to, the moment I say the word mortgage, and they're like, it's a dead man's pledge, which is what the word actually means. And so, we're securing against a property, house, building, a land, whatever it is a private mortgage. So what are some of the things that we look for or consider when we're trying to do a private mortgage? First of all, we need to understand what position the mortgage is going into. And how do you determine a position? Well, when a mortgage is applied, whoever applies a mortgage first goes into first position. Whoever applies second, and so on and so forth. Now, the reason that that's important is because if you ever need to liquidate the asset, meaning sell the house for some reason, and the bank knows this, whoever is in first gets paid first. Whoever's second gets paid second. So the things that you need to look at are, number one, you need to know what your loan to value is. You need to know, where's this property? How does it sell? The things that I help people to categorize it into are really three areas. You want to look at the collateral, which is the property. You want to look at a person's credit. What's the pattern in their credit? Are they people that pay? Are they people that don't pay? Is there something that's happened in their life, right? So their credit, and then the last is also character. We call it character, but you're looking at an application. You're looking at what's their stability of their job, what's their background, what's their assets, what's their liabilities, a lot of these items. And so in these three areas, you're going to get 95% of the picture of a loan. And so there's a lot of intricacies to that, but those are the main items that you want to look at and evaluate when looking at a private mortgage.
That's awesome. So does anyone have any questions that they would like to ask at this time? Go ahead, Jacqueline. Oh, here, let me unmute you one sec. Or you can unmute. I think I can ask you to unmute.
Unmute.
There you
Okay. Good morning, everybody, and thank you for your time. So if I borrow through a private lender like yourself, what are the additional borrowing costs? Is there an application fee? Like if I go, like right now, my mortgages are with CIBC, but if I went, what's the benefit of me switching from that to someone like yourself, getting a private lender? And what are the additional borrowing costs? Is the interest rate higher? And is there more additional cost to borrowing from you as opposed to CIBC Bank?
Right. Great question, Jacqueline. Nice to meet you, by the way. Yeah, so I guess I should start with, private mortgage versus bank mortgage, what we're looking at there. With a private mortgage, you've got a lot of flexibility. With a private mortgage, you don't have the same income qualification process. You don't have the same credit requirements. We have a lot of flexibility. The banks on the other side have a very strict box, and you've got to fall into those different categories. Your ratios have to be this, your credit score has to be this, your income, all of these things have to be that way with the banks. The banks, as I mentioned earlier, are lending, they're lending borrowed money. On top of that, I won't get into fractional reserve banking, but that's a whole nother thing, that allows them to lend effectively free money, and it's part of our system. So they're able to lend at these ultra low rates, which is great. And you definitely, if you qualify for it, you definitely want to use a bank in most cases. Now on the other side, we charge more on a private loan, private lending, because it's your own money, and you can't write off the risk in quite the same way that the bank does. And for instance, we saw last year in March when the banks were there was a crash, right? And what we saw was the banks sold a whole number of their mortgages to the federal government. And so all those debts, they just took them right off of their books, and they're able to continue lending. We don't have that option to be able to have the government just come in and buy any of those loans, questionable or not, off of our books. And so as a result, for that additional risk, we charge a higher amount. Now, in terms of the advantage for you, I would say the greatest advantage for a homeowner is usually when it comes to debt consolidation is probably the number one, and credit repair is probably the number one thing that we see, where people are borrowing loans from different places, and without naming some of the easy monies and the fair rocks, without calling them by their actual names. Some of these places that give you access to money really easily, but their interest rates are extremely high. And so what we're able to do is come in, help do a debt consolidation, pay out those loans, reduce their interest rate, and then help them to kind of get back on track. The other one is for the investor. A private lender can use, an investor can use private funds to be able to close on properties quickly. It gives you a competitive edge in certain places to be able to, you've got a property, you want to be able to negotiate, and the difference that you have is that you're able to close in 5 days or 10 days versus someone else that, has to go through the bank approval and might be able to close in 4 months.
So just another question on top of that. So, I mean, all my rental property, investment properties, I have a mortgage on those with CIBC Bank, and I definitely don't have to consolidate anything because I don't have personal credit or lines of credit. I don't own any of that. But in terms of scaling up my investment portfolio, I want to get into multifamily now this year. I want to dip my toes into that arena. And I've had a preliminary talk with getting funding for that through a bank, but it might, at a higher cost, it might facilitate my needs quicker if I go through a private lender. So if I do that, if I make an offer on a multifamily, do you provide a letter saying that I have guaranteed financing the way the bank provides a letter to put in with your offer on a home or something? Do you provide that letter for guaranteed financing to make your offer cleaner and more competitive?
Yeah, absolutely. I mean, now we just need to examine that word guaranteed, because the bank may provide a commitment and a private lender can provide a commitment.
Okay.
Both of those are not guaranteed. Neither one of those are guaranteed. And we've all heard stories of people that have had their commitment pulled by the bank, a week before, 2 days before the day of closing. And so it's not a guarantee in either case, because you never know based on information that comes up. Every broker out there knows of a story where they've gotten a commitment for a client and then they're getting ready to close. The day before, the bank does a review and realizes that the individual has gone out and bought a truck, and they pull their financing because the ratios no longer match.
Yeah, no,
right? So,
I understand that those.
yes, we do provide letters, commitments, so that you can waive your financing, understanding the implications as well. Yeah. Absolutely.
Yeah, so I understand that, you know, if someone puts an application in and they get like that can be pulled because someone, you know, unwittingly or an unsavvy investor or buyer, they change something in their application and,
Yeah.
you know, innocently enough, they relayed that to their lender and then, oh God, you know, this changes, this is a game changer now. But someone for myself who is aware of that, like, you cannot be changing, crossing a T, dotting an I once you do this until everything is finalized. Like, I'm aware of that. So, but so I know I wouldn't put myself in that position just because
Right.
of previous, just because I'm knowledgeable on that part of it. But so I just like, you know, so if I had that letter, it does make a cleaner offer. So I was just wondering if you
Absolutely.
offered that.
Yeah, absolutely. We do understand that. And, you know, being able to waive financing, absolutely.
Okay.
Yeah. And there's been a number of files that I've dealt with where someone needs to be able to waive. So in some cases, they actually get approved with private financing as the backup because they don't know if the bank is going to come through. They need to be able to waive their conditions, the finance conditions. And so they'll do that sometimes. And in that case, you know, the private lender might charge you something for it, saying that, hey, you know, we don't want to just do paperwork for the sake of doing paperwork. But for the most part, you know in advance where you're going to be. And yes, you can take that to the bank.
Okay. Thank you.
Yeah.
Thank you for your response.
Awesome question. Does anyone else? Yeah, go ahead.
Yes. So if I have a cash that I want to, and I will use my own line of credit to make private lending. So if my line of credit now is like 2%, 3%, because it is based on my prime residence, and I make use of this money and to do private lending, to lend someone else maybe 10%, 9%, whatever. This will affect me later on if I need to expand my portfolio in terms of if I need to buy more houses, because now my debt ratios will increase.
Mm-hmm.
Yes. What do you think about this?
Right. Well, thank you for the question. And how do I say your name properly? Is it Ramez?
Yes. Yes.
Ramez. Thank you. Thank you for the question. So the answer is, if you borrow money off of a line of credit for whatever purposes you use that money, that will now be applied to any ratios that you do with financing. But
it has an income, like it has because there is an agreement that this money will have an income. So why it will affect me?
That is how the banks would calculate it in, because they look at that ratio. They want to know when an institution is doing the calculation, what they're looking at is what happens if whatever that is, if it stops paying. If it stops paying you, they want to know, can you still handle the payments? They want to know that they're still going to get paid. So that's how they do their calculations on that basis. And here's where a private lender might be able to look at it. They would look at it and go, okay, well, you're making money from that as well. They're a lot more likely to give you credit for that. Many investors have run into this where they've got a duplex or a triplex, but the bank is only willing to credit them a certain amount, 50% of that income, rather than the full amount, right? So
I got you. And following that, if do you have an idea about if I make a lending to someone as a private lender, so what will be the tax implication? It will be like an income tax or a capital gain or what?
Yeah, you're now depend. I don't want to answer on behalf of an accountant, but it is income, and based on how your accountant best suggests for you to declare that, then yeah, right, because it'll depend if you're lending it out of a company, if you're lending it from yourself, what tax deductions you have, all of those kind of things. But it is income to be declared because it's business income.
I got you. Thank you.
Thank you. Great question.
Yeah,
Thank you.
great question. And I guess to add on to that, right, because it changes. For example, if you're lending out of your RSPs, it's defined as something different. If you're lending out of your tax-free, it's something different. So that's a question for the accountant, because it's not really like, depending on what your money is, can you really decide how the accountant will define that for the tax purposes.
Right.
Yeah.
Absolutely.
And if I'm lending from my RRSP, I understand that it should be done through some kind, like I heard about Olympia Trust or something like that.
Yeah. So you require a third party, which is an administration company, that are licensed to do that. So these are trust companies like Olympia Trust, Canadian Western, Community Trust. There's a number of them out there.
And what would be the
Sorry?
What would be the average rate? Like if I have some money in my RRSP, what will be the average rate?
Oh, that really depends on the amount of, I'll say really depends on the amount of risk that you take on. You can get, I've seen first mortgages at 4% on private lending, and I've seen as high as 18 to 21% on private lending on second or third mortgages. So it really depends. You have to look at it in a more detailed way for your own portfolio, your level of risk per deal, and what the loan to value is, this kind of thing. So it can vary greatly. I would say the average on a first mortgage is you're probably going to see starting at 8%, maybe to 8 to 10, something like that. And on a second mortgage, you're probably going to see something around the range of 9.5 to 15. But don't take that as the truth. But
that is like a guideline.
right. And that's right now. That's right now for what the market is kind of flushing out, is around there.
And I heard like someone before, he was an investor. He requested like a money, and he said that we will have like a personal commitment. Is it legal to have just a personal commitment and lend him the money?
Well, that's a personal commitment. That's not a private mortgage, but that's an IOU.
Yeah.
And, which still has validity, but it doesn't have the same security.
Yes.
Yeah, like it's not secured to a house. You really have to trust the person and know how their business model works and everything to be able to see if that's actually something that you're willing to do, I feel like. Do you agree, Neil?
Absolutely. If you're asking me, I don't advise it at all, unless it's a family member and you're fine with giving them the money, or a friend and you're fine with giving them the money, then by all means. There's lots of money in unsecured lending. You can charge insane interest rates on unsecured lending. And there's lots of people that do that and kind of take in the risk of, hey, I'm probably never going to see the money back from X number of them, but the ones that I do get paid on, I'm going to get paid sufficiently to enjoy that return. But that's a whole different game. And I'm kind of vanilla. I'm kind of boring that way. I like my life to be exciting and my investing to be boring. So.
Yeah, you're right. Totally right.
Yeah.
Thank you. Thank you.
Hey, I got a question.
Sure, go ahead, Alex.
Good morning, everyone. My question is, if I own a property and I wanted to do a mortgage, like a secured mortgage against that property for another property, is that something that's viable?
Absolutely.
What does that look like?
Well, for instance, I've got an investor right now who he's working on a flip. He's fixing up a property and doing some forced appreciation. And he was looking to bring on an investor for that project. And he thought, well, I'm selling this other property. Can I access the equity in that property before it sells to be able to use on this other property. So you can keep the job going. And absolutely, you can still register a mortgage onto that property, access the funds, the equity from there, and then when the property sells, then we'll get paid back, and plus he'll have whatever extra he makes from that deal. And in the meantime, he's been able to continue to invest in the other property. But you can just as easily use it to put it as a down payment for another property, or depending on the amount of equity you have, you can use it to completely buy out. Again, depending on what you have available, right? So.
Thank you, Neil. I have a follow-up question. What about partial security? What about like, what if it's not like fully secured? What if it's only secured to half the amount? What does that look like?
I'm sorry, could you say a little bit more about that? Half the amount of? So
let's say I wanted to borrow like $100,000, but I only have equity of about $50,000 in the property, and it would be like partial security. What does that look like?
Right. Again, so now what that would look like is you've got a first mortgage, you're putting on a second mortgage, so there's already an additional amount of risk. So you've got to kind of factor that in, and you're only in specific situations are you going to lend up to 100% loan to value. You're going to choose when you go up that high. For the most part, you're always going to leave a buffer in there. And what we tend to do is 80 to 80% loan to value maximum, so that there's always a buffer, so that if something ever happens. So what you're going to get access to is the difference. So if you've got 50%, you're going to be able to borrow up to 35% of that equity, 35% of the value, to be able to move into something else. Does that answer the question? I'm not sure if I got that one right.
Yeah. It does answer the question. Is just like, I was just kind of referring to, what if all I had access to was, let's say, the 35% or the 50% was $50,000, and I needed 100, and just kind of writing up a mortgage with partial security. You know what I mean?
Right. So as a private investor, as a private lender, if you want to do that with your cash, you can absolutely do that. I don't recommend it, especially as in mortgages, and as a licensed professional, we would never recommend to someone to lend over the value of the property. But, or maybe, and for the private investor, you can look and go, this property is going to be worth more. And you can very easily lend more than that. And so absolutely. Can it happen? Absolutely. Do I recommend it? Never.
And I guess to just add on to Alex's question, because he's a flipper, so I feel like I know where he's coming from, is that I think it's also just, just so people know, like when you flip it and you sell it, because maybe even like you put it on there, or even you put it on like, higher than 100% loan to value. But you have to realize when you sell it, if you're still going to have to pay that back, right? So, and I think that also leads to when something like cross collateralization, which maybe you want to talk about now.
Yeah, and actually now with that scenario, I can definitely speak to it. If you're flipping a property, in some situations you can do something like, as an investor, there's 50,000, you actually need access to 100,000. You can register a mortgage. As an investor, I can go in and I can register a mortgage for 100,000. Now I'm $50,000 over, and I might only give you 50,000 initially. You start working on it, and then I might advance you more as you work on the project up to that 100,000, as we agree that the value is increasing. That's definitely a way to do it. Or if you've really built up a familiarity and comfortability with an investor, that investor may know the work that you do, and they may just give you that 100,000 right up front without waiting for it, because they know your track record. So that you can completely do that. The other thing that you can do for people that have another property, or maybe a relative that's willing to allow them to utilize their property. And here's something that I've seen. Joe has got a house and he needs to borrow $100,000. He's only got access to $30,000 in his home. But then dad, Jeffrey, has got his property and it's free and clear. And so dad says, yeah, sure, go ahead and put a blanket mortgage. So we put that same 100,000 mortgage onto his, and you're able to utilize that, the additional portion. And then once you pay it off, then we just remove both of those mortgages. So that's another way of, to get around it. And I've seen a number of, especially multi-unit family investors, where as you gain equity in a property, you don't want to touch the first mortgage. So you'll access the equity in each of those properties to then take that money and go buy another property. That's quite commonly done.
Neil, I have one last question. Sorry, guys, if I'm asking lots of questions here. My question is, with all the banks now being very kind of strict about the second mortgages, like what are the options here? Like, what other options for lending are there? Because realistically, like, a lot of the mortgages coming out are saying no second mortgages. So now what? Can we do a self-directed something? Is there, like, what are the realistic options here for second mortgages in this current mortgage environment?
Right. Great question, Alex. Any loan applied to real estate is a mortgage. If you use a self-directed account, same thing. And any of these things, the moment you apply it to the house as security, it becomes a second mortgage. For that matter, HELOCs, home equity line of credit, is a second mortgage. So, a HELOC is one option that you could use. But I will say that a lot of the institutions, the banks, although they frown upon second mortgages on the property, or they'll say, we don't want you to have one. Most of them will not rescind your mortgage if you've got a second mortgage. They might tell you, hey, we want you to remove it, some of these things, but for the most part, they just allow it at any rate. But what other options? You said you asked about other options. I'm not sure. I'm sure there's other things that you could do, get money from other places, but in terms of other than private lending, like for a second mortgage, that's kind of what we deal in. So
thank you so much, Neil.
Yeah. Family. Borrow money from family. That's the one.
That's right.
Anyone else have any questions that they would like to ask?
I just posted mine in the chat. I'm not sure if you guys are monitoring that, but
Okay.
yeah, I was just wondering about, like, private lending scenarios. What should we be looking for? The criteria, fees involved, risks that we have to protect against. How do we protect against those risks? That type of line of lending, because some of us are pretty active in that. So
yeah, I can definitely take that on. Dinah, is that okay? Can I answer that? Okay, great. Well, Marco, thank you for the question. And okay, so your question is with regards to specific scenarios or private lending scenarios, the criteria to look for. So as I mentioned, the three C's that we like to look for. When I'm looking at collateral at the property, I'm usually looking for what's the state of the property, right? What's the state of it? Does it look good? Is it, when you get an appraisal, it'll even rate it at good, average, fair, below average. They'll give it a rating as well. But when you look at it, it's almost just through an appraisal, or if you go and visit the property, you give it a bit of the eyeball test and go, you know, what does it look like? And you're going to get a feeling about that. As you see more and more properties, you'll get a feeling about the just the eyeball test. And hey, what does it look like? In terms of for resale, because in an appraisal, they also talk about resale and what the market is like locally. So for instance, because I'm always looking at it from the worst case scenario, anyone can get into a deal. I want to know how to get my money out. And so I start with that. So worst case scenario, if I had to sell this property, does it look like it's ready to sell? Yes, no, maybe so. How long is this market, depending on the markets? Because we actually like, and I recommend lending outside of the major urban centers where markets are less volatile. Now, some people don't like that because it might take 60 to 90 days of exposure, or it might take, could take 6 months in certain locations to sell a property. And so depending on your risk tolerance, those are factors to look at. How quickly can a property sell? Some people love the big markets because they know you put a property up, it's going to sell in a day or two. And so you want to look at what's the average days on the market. Now and so there's other things I look at as well when I'm looking at an appraisal. I want to look at the notes, get an understanding of what the appraiser has seen while they were on the ground, while they were reviewing. What are some of the concerns? It just gives you an overall picture of the property. And depending on your comfortability, what type of properties you like to lend on, you're going to see trends in that area. So I can't really speak to that because there's so many different items there. If you were lending on land versus if you were lending on a house versus if you're lending in commercial. So now the next thing, when you're dealing with credit, the things I look for the most on credit: past bankruptcies, consumer proposals, and probably the most important thing, even more important than the bankruptcies and consumer proposals to me, is what is their repayment habit? Do I see this happening on a frequent basis where they're missing payments? Or is there you can literally see where there's a major event, something has happened, and everything circles around, all the bad credit circles around one point in time. And it may be a divorce, it may be, something, an illness in the family, a death in the family, who knows? And so that really can show you that, okay, their habits normally are, they're very good, but their credit went down because of something. Well, now I got to find out what that something is, right? And so you go down that road. And then bankruptcy and consumer proposals, those are also important pieces, but there's a whole lot of legality behind those. So you're going to have to get details on those. And then the last one that I always talk about is the character side. The person's making whatever income they're making. Does that seem reasonable for whatever the job is, right? You can, of course, ask for documents to prove all of these items. In private lending, a lot of times people don't ask for proof of them. So in that case, you've got to then turn around and say, well, is that even reasonable for that to be the case, for someone to make that much money in whatever that job is, or in that business? That's probably one of the harder ones. If someone's self-employed and they just state a certain income, how do you know that's actually the case? You're looking at their liabilities. What do they have for a debt load? Am I seeing, these check cashing places? Are they all on there? They've got loans to the check cashing places, which we know are one step below loan sharking. There's something wrong there with cash flow if you saw something like that, right? And so me personally, and I shouldn't say this, but I'll look at what are the cars, what are all of these types of things, because they give you an overall picture. and you just want the picture to be consistent. And so you look at their employment, the income, you're looking at the debts, and then of course you're also looking at whatever the previous mortgages are and those types of items as well. And job history. Job history is also a vital one, because we may actually lend money to someone that doesn't have a job currently, but what's their history been? They've worked for the last 20 years and something happened, and now you can see that they're unemployed. Well, we might be a bridge. They might want to access the equity from their home to be able to bridge them until they get back. Maybe they had EI, or maybe they were self-employed and they didn't qualify for EI. So in that situation, they're using the equity in their home. So there's a lot of scenarios around that, but this is where I share about having worked for the government and getting to know people in their pasts and getting into those things. That's where a lot of this stuff ended up coming out. And so for you, that's another one that you want to look at. And then just put the whole picture together. Does it make sense? Does it look right? And ask those questions. So as an individual, I would say that's what you do. But if you want to know what we do, there's a lot of that. We want to get that picture, and it needs to work, needs to be cohesive. And if it's not, I'm going to ask questions about it. Yes. You're on mute.
Hi, Neil. I'm Deborah.
Hi, Deborah.
So I like that information that you just shared with us about checking collateral, credit, character. But I'm just wondering, as the lender, do I have access to that kind of information, like their past bankruptcy, their job history? Like, can I access that, or do I have to rely on someone like you, the mortgage broker, to give me that information?
And that's a great question. Obviously, that's where I'm able to assist, because I would get access to all of that information, and then I can advise you on that. You can ask for some of that information, or you can ask for that information. You can ask for a credit report, and they can provide it to you directly. You can ask for them to fill out an application, and they can provide that to you directly. You can ask for all of that information, and you can go through a lawyer to request this information from them as well. So can you get access to it? Absolutely. And you can have standards on what you will use. You may choose to use a third-party credit provider, service provider, or you could ask them for a credit report directly from Equifax. In some cases, some people already have access to being able to pull credit reports because they've got tenants and they've already got access to some of these services. So you may be able to do that. Just be aware that any of the credit bureaus, whether it be Equifax or TransUnion, they are pretty specific on what you can use that for. So if you're using it as a landlord for your tenants, they actually care if you're then using it for lending purposes. So just be aware of that. But you can get access to it. That's obviously the advantage, one of the advantages of going through a broker.
Okay, thank you. Just one other question. You said consumer proposal. What is that?
Okay, so when people are in financial troubles, they usually look to one of the two main ones, either bankruptcy or consumer proposal. A bankruptcy we're pretty much familiar with. A consumer proposal is when a trustee will actually, and for all the trustees that are out there, I'm sorry if I butcher your job, but basically they're going to contact all of the debtors and work out a proposal to pay a certain amount. And a lot of the cases they'll negotiate a lower amount to settle that at, and over X amount of period of time, that here's the payments we're going to make. You stop charging interest, these kind of things. And then someone's got to pay it until they pay it out. And in a lot of cases, I've got a file right now where they've got 4 years left on their consumer proposal to make all those payments as assigned by the trustee. But that means that that's 4 years before their credit will start repairing. So we're now looking at, they're asking if we'll come in, do a private loan, pay it out so that now their credit can start repairing. And now they're just paying the private lender instead. There are other options I try to recommend to people rather than bankruptcy or consumer proposal that will cause much less damage. But those are, that's a whole nother field out there, and I don't want to upset any trustees out there. But if you've got questions about debt settlement, feel free to ask me separately.
Yeah, I guess I'm just curious about where, as a lender, we can find out about bankruptcies and if people have consumer proposals on record. Where would we find?
Well, the moment you see it on the credit report, if you request that credit report and you see it on there, the moment you see it on there, you can ask them for documentation around it. And the key word is satisfactory documentation, so that you're looking through, they've given you something. No, I need the discharge letter. Like, there's something that a lot of people, you want to make sure that bankruptcy has been discharged.
Right.
Right. Now, your lawyer will help you navigate most of these items as long as you've got a competent real estate lawyer, they'll help you navigate that. But for the most part, you just want to make sure that these items are discharged and you're good, because you don't want to find yourself all of a sudden behind some other loan.
Okay, thanks.
All great questions. Anyone else have any other questions? Last question, because I know, oh yeah, keep on going, sorry, go ahead.
Okay, so I'm not sure if you're kind of done the original line of questioning. If not, you can go there, but also I want to understand is, what do I do to manage my debt, manage my loan, my lend?
Right.
Yeah, so how do I manage it moving forward, making sure that everything's good, and then what do I do if it doesn't go good?
Yeah, great question. So, with regards to the management, it really depends on how you've set up the loan in the first place. If you're getting monthly payments, depends on how you're getting those payments. Depends on whether if you're using registered funds or not, right? So if you've got money with a trust company, they'll actually handle the administration for you, right? Like, they'll take the loan payment directly out of the homeowner's account. It'll go directly there. If there's a problem, they'll notify you. If you're doing it on your own with your own cash, not registered, then of course you're just going to have to monitor either the payments or the checks that you're collecting. However you're collecting it, you're just going to have to monitor to make sure that those payments go through. If there's a problem, then you're going to have to follow up on it or have your lawyer follow up on it, depending on what your process. For us, my clients typically just give me a call, and then we'll follow up with it from there and then let you know. Again, that's just something that we'll do in the process. As long as we're not, as a licensed individual, we're not licensed to handle the money. There are actual mortgage administrators that you could even use as well to have them do that for you as well. But in terms of calling the homeowner and that, we normally will do that for our clients. Now, I think there was another question. So the other part of your question that you didn't ask specifically was, what happens if they don't pay? Then what are you going to do? And that's a really good question. For you specifically, there's a lot of different scenarios out there, and you're going to have to assess that scenario. If you're doing it yourself, you're going to have to assess that scenario and decide, is this the point in time where, hey, they're not paying us, we go straight to a default process, or am I going to give them more time? It really depends. I can give you an example from last year when COVID hit and there was lockdowns, and we had a couple of people call and say, hey, what happens with this mortgage if I can't pay it? Am I able to get a deferral? Well, there's no process in place like there is for the banks. And we said, let's work on it. You can talk to us, and we can definitely talk with the lenders specifically about working out some sort of arrangement. And so that was a very unique situation. Well, global pandemic, that a very unique situation. And in fact, we actually had no missed payments. Even those people that called they ended up working it out themselves. So there's some intricacies. Your lawyer can usually help you walk through those details. Or if you decide to utilize us, then we can help you through that process as well.
And so let's take an example. Let's say there's somebody wants to borrow for a flip. So 3 month for fixed, 6 month open. Should they be sending progress reports? Is that something that you look for in your process? Is that like?
You can absolutely, any of those items you can ask for. So for instance, if it was a flip, we're going to have a draw schedule and there's items that they have to meet before we're going to advance funds for the next portion. In most cases. Now there might be, again, this is where it comes back to, you might have a comfortability with this flipper, this investor. And so you might be like, no, we don't need any of that. We're good. I know this person and I'm fine with lending them the money in its entirety, or lending them this much at this time, this much at this time, this much at this time. That's some of the flexibility you have. Otherwise, I'd have a draw schedule, have all of those items detailed in advance so that they are met before you advance the next portion. And it's registered with the lawyer as part of the contract.
So if we were working with you, let's say, would you say call Marco up and say, Marco, I've got a deal. I've already done all the due diligence on this borrower. Yeah. And here's the list, and then you send it to me, and it's like, and then is that how it works?
Yeah, that's typically how it works. For me, it's sort of a bit of a first come first serve. If you like the deal, let me know, and then you get back to me. And then any and every question that you have, I'm legally obligated to reply to and give you the information on. I'm usually going to give you the story in advance, give you the whole story about it, all the items that I think are of concern. And then of course you're free to ask any questions beyond that, and then go from there. And you're able to, of course, decline a deal pretty much at any point. As long as, me personally, as long as you're not, yeah, I'll do this deal, and then later on, hey, I don't feel like it anymore. We may not do business in the future, and I'm sure you can understand that. But as long as it's reasonable, then yeah.
Can I just ask one question along that line? How do you make money as a mortgage broker? Is it fixed? How do you make money on?
Yeah. So when because I'm getting sourced these deals on an ongoing basis, I'm providing quotes for knowing my investors. I know roughly what they're looking for. And so I'm doing all of this process in advance continually. And so when a deal comes through, I've already quoted in my fees into that deal. And so then when I provide out a deal, I provide it out with my fees subtracted from it already. So what you're going to see is the amount that you would be getting, and then my fees on top of that's already negotiated with the borrower.
Oh, okay.
That they're going to pay my fees. Same thing with legal fees, all of that stuff. They'll be paying all of that as well.
So what are your usual, like if I want to borrow, like what are your fees?
Oh, that varies greatly, really depending on the deal, the risk, my familiarity with the person. If you're an investor and we've done multiple deals together, then we've already got files on you. We've got you can do that process quickly, right? So you can afford to charge less. Or sometimes there were periods where I had a product that we were promoting for really low loan to value files. Didn't make a lot, well, in our area, they didn't make a lot of interest. They were about 8 to 10% interest loans, but they were meant to be for low loan to value files. And I think I was charging maybe $300 or something like that, because I wanted my investors to get their money out there, because we were having a slow time in the market when we were doing that, right? So it really depends on a file. Then there's other times where, you know, I might charge significantly more depending on the work required in behind the scenes. So yeah, it depends.
And as the lender, do our fees get covered on top of the whatever?
Yeah,
whatever the deal is?
yeah, your fees are all in there. So every deal in terms of with me anyways, well, let me back this up. Industry standard for people that are doing this type of lending, typically you're going to get the interest rate, and the broker or the company is usually going to get the lender fee. That's the standard. One of the things that I do that varies a little bit differently from them is that I will actually break up some of that lender fee in many cases. If I think there's additional risk, then I'm going to add on that lender fee to the actual investor as well. But it really depends on a file, because if it's a low risk file, then for me to be able to be competitive with that lender fee's got to be a lower amount as well, right? So there's got to be a way for everyone to be able to enjoy on that one, right? So we usually divide it up depending on the deal. And again, you'll see that for me, I disclose that right from the get-go. Whatever number you see is everything included for the most part. Sometimes I might not include some of the extra fees that you're going to get as well at the end, at the maturity, but it depends. You know what the old saying, under promise, over deliver. So.
Okay, and when you send me a package, will you be pointing out various, I use the word derogatory in the sense from a financial perspective, you know, oh, I noticed, are you going to call them out for me? I hear the risk.
Absolutely. Yeah, that's you're going to know. And when I put it out, you're going to see it right off the get-go. Here's the concerns. Here's a couple of the concerns. And here's the reason that they're borrowing. Like I actually look at it this way. I don't know if this is a term that I just use, but I call it purpose-driven lending. I want to know what the purpose is, because I'm going to relay that to you, because I don't want someone just in this world. Why are you borrowing, you know, at 10, 12% on your mortgage when you could be going to the bank? So there's got to be a purpose for it. Let's find out what the purpose is. And it might be that things are great and you're investing in another property. It might be because things are really bad and they're going to get worse. And so we want to know what that is too, because we're not afraid of that if we've got a legal process in place for handling whatever it is in the worst case scenario. We've looked and funded deals that were in a power of sale situation, bringing someone back from it getting sold out from under them. But we knew what the implications were and how they got there. And so we were okay with doing that. So absolutely, there's a situation where the derogatories are the deal. Right? And in most cases, the derogatories are the deal. The person has gotten here because of something bad, and that's why they're going to pay you extra. That's why they're going to pay you more, because they can't go to the bank. So yeah, that's our opportunity.
Cool.
Thank you so much, Neil, for all the information you provided. It was very informative. I'm pretty sure everyone enjoyed it. Would you like to share your details for anyone that may want to get in contact with you?
Oh, sure. Well, you can, if you want to find more video content or anything like that, you can always look up hashtag Neil Mortgages. Got tons of stuff out there. or you can look up Ontario Private Mortgages .net and the website, or you can contact me directly at 647-526-2900 and or email me at ontarioprivatemortgages@gmail.com. And yeah, happy to communicate. You can find me most social media places: Facebook, Instagram, TikTok. I don't dance though, but yeah, you can find me in most of these places. So yeah, well, I don't dance on camera.
Not to the public. Behind
Yeah,
closed
that's
doors.
right. That's
Awesome. Thank you so much. It was really awesome to have you on, and a lot of great information provided. And thank you to everyone also for coming on and participating in this meetup.
Yeah, thanks so
Thanks.
much, guys.
Thanks,
Great.
Diana. Thank you, Neil.
Thank
Thanks,
you.
everybody.
Thanks, Neil.
everyone.
Thanks, Diana.
Bye,
Have a great day.
everyone.
Bye-bye.
Take care.